Welcome back to Factful Finance, where we dive deep into the world of money and investing to make complex financial topics easy to understand. Here's a surprising fact: over 60% of investors still don't fully understand the difference between stocks, bonds, and money markets. If you're part of that group, don't worry. We're about to break it all down for you. Today, we're answering a question that comes up all the time. What exactly are stocks, bonds, and money markets? And more importantly, how can each of these investments play a role in your portfolio? Let's get into it. Before we start, a quick disclaimer. This video is for educational purposes only. Please consult a financial advisor for personalized guidance. Let's kick things off by looking at stocks. Stocks represent ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. For example, when Sarah invested in 100 shares of Apple stock back in 2012, she was betting on Apple's future growth. Stocks offer potential for high returns, but they come with higher risk. If the company performs poorly, so does your investment. Let's take a real-world example. If you invested $10,000 in Amazon stock in 2010, that investment would be worth around $170,000 today. But remember, while stock prices can skyrocket, they can also crash. So if you're looking to add stocks to your portfolio, you'll want to consider your risk tolerance and long-term goals. Bonds, on the other hand, are a form of loan. When you buy a bond, you're lending money to a government or corporation for a fixed period of time. In return, you receive interest payments. Think of it like being the lender in a bank loan. Bonds are generally considered safer than stocks because, in the event of bankruptcy, bondholders are paid before stockholders. For example, when a company issues a bond, say a 10-year bond at 3% interest, you'll receive regular payments over the term of the bond. While bonds won't make you rich overnight like stocks might, they can provide more stability and regular income. A diversified portfolio often balances stocks with bonds to smooth out risk. Finally, money markets are short-term investments that typically offer lower returns than stocks or bonds, but are safer and more liquid. These include things like money market funds, certificates of deposit, CDs, or treasury bills. For instance, a money market account at your bank might offer you an interest rate of 0.5%, which is far lower than what you could earn from stocks. But the key benefit is liquidity. You can access your money easily and with minimal risk. If you're looking to park your cash temporarily and earn some interest without taking much risk, money markets are a solid choice. So how should you combine all three? It's all about diversification. Think of your portfolio like a pie. You want a mix of ingredients, stocks, bonds, and money markets that work together to provide growth, stability, and safety. A 30-year-old investor might have 80% of their portfolio in stocks, 15% in bonds, and 5% in money markets. Meanwhile, someone nearing retirement might shift more into bonds and money markets to reduce risk and focus on income generation. Here's a practical example. David, a 40-year-old professional, invests in a mix of stocks and bonds. When the market drops 10%, his bonds help cushion the blow. He's still positioned for growth over the long term with stocks, but his bonds provide a safety net. To sum it up, stocks, bonds, and money markets each play a unique role in a well-rounded portfolio. Stocks bring the potential for high returns, bonds provide stability and income, and money markets offer liquidity and safety. Understanding how to balance these is key to making your money work for you. If you found this helpful, let us know in the comments. Do you already have a diversified portfolio, or are you just starting to build one? What's your next financial goal? And before you go, if you found this video useful, why not subscribe so you don't miss out on more actionable financial tips that can help you take control of your financial future. We've got new videos coming your way that you won't want to miss. Thanks for watching Factful Finance. See you in the next one.